Have you adjusted your portfolio to think about the new inflationary environment that we're living in? What is the proper role for hard assets in a properly diversified portfolio? This is Make Better Wealth Decisions, a podcast about financial blind spots, decision making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. My guest this week is Greg Rubbant. He is the president and founder of Centurion Asset Management, Inc. He has over 30 years of industry experience, and just last year in 2024 was recognized as CEO of the Year by the Wealth Professional Awards. I cheered lustily because I was in the crowd when all that happened. Greg, welcome.
Thank you so much for having me.
You and I spoke a little over a year ago before the podcast was rebranded, and we talked about a number of things. And one of the reasons why I wanted you back, because I don't have a lot of guests appear for a second time, but it's really important, I think, that people get a chance to hear your message with regard to the world that we live in 2025. And I guess I'd like to begin by asking you to offer your thoughts on the world as it is, specifically as it pertains to inflation.
Sure. So I have made the argument really since the start of COVID in a few white papers I've published, four of them out now, where I've talked about the world post COVID is an inflationary one. It was not transitory. We all know that. I was one of the first ones to call out that this was going to happen. Subsequently did. But there's a couple of problems, right? COVID showed us that certain countries were not to be trusted, in particular China, and that we were extremely vulnerable for certain key things like medicines, et cetera, and medical equipment. And this would continue to drive this deglobalization trend and a reshoring. So it became apparent how vulnerable all countries were in an open and free trading system. If borders close, it's really problematic. So one of the things that has allowed a disinflationary trend for the period, like the 40-year period up to COVID, was globalization, because it allowed expensive countries like Canada, United States, and countries in Europe to export jobs and high wages to poor countries. So I can't say that was ever a great trade for workers and the rest of in those developed nations, but for the underdeveloped nations, that gave them a chance to emerge. There is a number of key challenges. The reshoring and deglobalization are inherently inflationary because you cannot reverse what took 40 years of globalization to create that disinflationary environment and hope to reverse it over a period of 10 years or so and not think that's going to cause some inflation. So if we're going to have to go from paying workers $3 an hour to $25 an hour, well, that's going to flow through in costs. But it has to happen, not only because I think the world is less secure, but that there's not really the appetite for having this risk to foreigners or foreign countries really being able to control you. So certainly the Ukraine war accelerated this because it showed that countries like Canada or in all of Europe had dramatically underinvested in their military. So if you think about, we got this peace dividend in the late 80s and early 90s, and everyone talked about it back then. So you had these trends, globalization, and this peace dividend, which allowed us to take money and put it into other things other than the military. And now we've had both of those things go into reversal. So one, we've got reshoring, deglobalization, and Trump's tariffs are really just a reflection and acceleration of that deglobalization trend. Remilitarization. Now we've got something else that has taken the narrative recently, and that has to do with AI. So AI is an existential technology in the sense that we can't allow hostile nations like China to own the AI space and then have super intelligence so that their apps can tell us what to think and what we get to see and hear, and possibly ability to penetrate military systems or critical infrastructure. So the amount of money that's required to build the data centers and to build the energy plants to drive those data centers is another huge cost. So now we compile all these forces. So renewed defense spending. Canada's investing about 1% of GDP. Trump wants us to spend 3 to 4. Our commitment's 2, but let's just pretend it's 2, okay, which is still low. So we haven't invested for about 30 years at 1% of GDP. So let's call that 30 points. We need to catch up and to get to a core 2. So, well, that means 30 over the next 10 years. Where's that money going to come from? And it can only get printed. Then to reshore these companies back to Canada or to the United States or to Western Europe, wherever, is going to require massive amounts of capital investment. That money must be printed. The building of AI and the energy infrastructure to run it must also be printed. So this is why I think the next 10 years are going to be an inflationary one. We can see these little bumps along the way, but core inflation, I believe, for the next decade will be generationally high and unfamiliar to most people.
You talked about tariffs a moment ago, and I don't think we can have a conversation in 2025 about geopolitics and inflationary trends without
Mhm.
going into a little more detail about tariffs. As we record this near the end of February, we're being told that the tariffs where we had a 30-day reprieve are nonetheless very much on the table come March. And the sense that I get is that so far capital markets have yawned. They have not reacted as if this is a real thing, that the threat is real. And it strikes me as being fantastic that should be the case, because everything we have seen from Donald Trump is that when he says he intends to impose tariffs, he does it. And yet, markets, which are supposed to be efficient and supposed to internalize and accommodate prices based on information the moment it becomes available, this is information that has been known for weeks, probably even months, depending on how much you listen to the rhetoric, even prior to Donald Trump being sworn in. And yet, the market is not being particularly fussed about this. Number one, why do you think that is? And number two, what do you think the impact of the tariffs will be as time goes on, in addition to what you've already said?
So again, I think tariffs are really just the continuation of that deglobalization trend. I don't think that we're going to be able to avoid them in their entirety. So there will be some consequences. Let me give an angle for tariffs in the theme of deglobalization, robotization, softwareization that I've talked about in years prior, but I think is reflective. So if you think about tariffs as a way for protecting domestic industry, that's essentially what it is. What Trump is trying to do is, I think he's trying to get ahead. And this is one of the things I've tried to reconcile in my own mind. Is what is the impact of robotization, softwareization today, and goes into that category of AGI, right? Or artificial intelligence. But what happens? It's been estimated a third of all people could lose their jobs, right? Which is inherently disinflationary on one hand, but you can't allow that many people to be unemployed. So what do? You maybe have to print the money to support them. Society hasn't worked that out yet. However, there is a way out for winners. And the winner is the winning strategy is beat everyone else to the punch. And if Trump's strategy to defeat the disinflationary impact or the mass unemployment impact of having AGI robots do a lot of work is to make sure that, well, there's going to be enough jobs not enough jobs for everyone, but there's enough jobs for all Americans or all Canadians or something along those lines. And maybe he's just trying to get ahead and say, I do think he is. US, they want it to be the center of the world for technology and manufacturing. So to the extent that he can put up these barriers, which makes it harder and incentivized because it's the world's largest market, okay, foreign companies, invest here, create jobs here. And that can be a very attractive strategy. So now to go back to why the stock markets seem to be just yawning to the threat of tariffs. I'm on the one hand, I'm puzzled. On the other hand, only the only explanation other than what some have floated is that, well, we can't really ever figure out what Trump's going to do. So he's going to negotiate his way out. I think that's the wrong way to look at it. But if this whole drive to government efficiency is actually effectual and there are billions or to try for trillion, but if they get hundreds of billions of dollars out of government spending, well, then that's a potentially disinflationary force. Could offset maybe in its entirety the impact of tariff inflation. I haven't heard too many people talk about that, but that's the only thing that I can seem to intuit other than they're ignoring this risk.
So I don't want to go much into politics at all because that's beyond the purview and the mandate
Mm,
of the podcast. But
yeah.
I can't help but notice that this is the sort of thing where even if everything you say is true from an economic perspective, politically, there will be people who will be put out. And people, certainly people putting out their flags in Canada and booing the US national anthem. I mean, the animosity and the antipathy toward our neighbors is higher than it has been, I think, in my lifetime.
Yep.
And I don't
I
see
agree.
that lessening. And I think the idea of reshoring, even if the jobs do come back, there will be a painful transition and it will take years and there will be losers in the process. And so, even if everything you say is great in, let's say, you're saying 10 years. So, let's say everything is great in 2035. Between now and things being great, there will be, as the saying goes, you might have to go through hell to get to heaven.
Yep.
What do you think that has in store for capital markets, and what does it have in store for political leaders who are trying to navigate getting to the right place, but keeping people more or less happy in the interim?
I don't know if people can be happy in the interim. I have struggled to figure out when a leader would come forward and say, all right, there's going to be some pain that's coming, where the reversal of globalization is going to be painful. Reshoring is going to be painful. Building the military is going to be painful. The AI race, we cannot lose. So, in order to protect the democracy and the livelihoods that we have, we're going to have to make a sacrifice. Now, historically, nations have bought into that. When World War One, World War Two, populations have signed on for hardship, knowing that these were an existential crisis. Trump is the first politician. Again, I'm not trying to get political, but Trump a few weeks ago, I'm trying to remember the quote. I'll pull it up for you, but I'll paraphrase it. He essentially said, could there be some pain? Yes, but maybe not. But we're going to have to make the sacrifices to get to the other side. Is essentially paraphrase what he said.
Yep,
It
I
was
remember
really
this.
the first one to say, this is not going to be easy, but we have to do it. And I haven't seen central banks like they talk about fighting inflation and stuff. But in the period after World War II, there was inflation that was higher than today, so 8, 9%. And the 10-year bond was pegged at 2. Now, why was that? That was deliberate policy of printing money to essentially allow the US economy to grow its way out and reduce the debt to GDP. And it was financial repression. So we are going to be in an environment where there's going to be financial repression. And we just haven't got a politician in Canada yet who's been able to say that. I think that they're going to adopt it and other countries are going to adopt it as well.
Okay, so speaking of the environment, perhaps you could take a moment to explain to people listening the role of hard assets in an inflationary environment because it's a prescription that I subscribe to. But I would say that within the financial services industry, I'm oftentimes in the minority. And I want people to make rational decisions. The whole podcast is to get people to make better wealth decisions. And I think people are making decisions as though the past 40 years, the tailwinds of a bond bull market from 1980 to 2022 and of globalization from at least the peace dividend of the Berlin Wall falling in 1989 until perhaps Trump's first election in 2016, as if those things haven't changed and we're in a new world right now. So maybe if you could take a few moments to lay out the
Yeah,
case for hard assets and investing for an inflationary new world.
that's a good starting point. Let me first go from the other side, which is if you look at the bond world, right? And today, Canada bonds are 3.2%, give or take. If I'm right, we have 3 to 4% inflation for the next decade at best. The bond yield, pre tax, adjusted for inflation, is effectively zero. Adjust for tax, now you're making, call it minus 2% yield. So very unattractive, but to the extent you can borrow for things like hard assets like real estate, funding by borrowing at those rates and effectively borrowing money for a real rate of close to zero and owning an asset which reprices itself with inflation, such as rents. And rents are strongly correlated to inflation. You get some bopping around the center line, but in these environments, you have to have things that are going to protect you. And real estate has got one of the longest track records in being able to do so. Commodities can be good. And I do like commodities, but they could be very choppy and very cyclical and can over and undershoot by large margins whereas that's less likely to be the case in real estate.
Let's see if we can compare and contrast
Yeah.
hard assets with traditional financial assets, stocks and bonds. What would you the next decade or so as we do this
Yeah.
transition to look like for financial assets?
Like I said, I don't have very high hopes for fixed income. And if you look at stocks, they're trading at earnings multiples that I struggle to understand. And if you look at like Schiller ratios, they imply 10-year forward looking returns of 3%. Now that's not a projection, but it's what the Schiller PEs at where they are imply. So, I mean, I'm not saying you don't have financial assets. I think you need to have a diversified portfolio, which includes some stocks and you need some liquid stuff there too. Not necessarily bonds, some T-bills or something like that, something liquid cash to meet your needs. But you gotta have something in there. Like I personally do trade energy and I do trade gold and Bitcoin, and those are part of my hedges as
Right.
well for inflation, in addition to what I do for Centurion, which is owning apartments. But I wouldn't be very hard today to make sense of the stock market at these current valuations.
Just so that we can maybe put a little bit of meat on the bones, could you perhaps venture into for the non-income portion of a portfolio, what percent would you say should be hard assets and what percent of the remainder should be in financial assets? If it were
Mm.
up to you, if someone were to come to you and say, I've got a blank slate, I've got $1 million, I'm going to put X, Y, Z
Yeah.
into income, and you're going to say, well, I don't like income at all. Okay, well, whatever you do for the non-income portion, how would you divide the remainder between financial assets and hard assets?
So one of the characteristics of hard assets is they tend to be less liquid. So that's not a question you could say for somebody who's got $1 million and that's their total nest egg. I don't think you could be 50%, right? Because you might have some kind of job crisis, you need to buy a house, you get divorced or something like that. You're going to need access to things that are a little bit more liquid. So tend to be financial assets, right? I think removing those life emergency change of life situation, liquidity needs. I myself personally, I'm more than 50% in hards and have very little in terms of financial assets. I have some because I think you got to have some as part of my liquidity bucket, but I'm personally over 50% in hards.
All right, let's
Just,
see if we
and
can.
that's also because of where I think the world is going. And if we go into a disinflationary environment in a decade, that that might shift. But I've got, a specific view of pricing and of, pricing of relative assets, but also of inflation that's directing me in that direction.
Fair enough. Let's talk about investor psychology. So
Mhm.
you might be fairly familiar with the work that was done by Kahneman and Tversky. Kahneman won the Nobel back in 2002 surrounding the concept of risk aversion. And I have spoken frequently about the Schiller PE being ridiculous. I actually think my understanding is that the cyclically adjusted price earnings ratio on the S&P 500 right now is over 38, and that would actually, if history is any guide, lend itself to an annualized return over the next decade of zero, not 3%, zero.
Yeah.
So it's that scary. But a lot of making better wealth decisions revolves around controlling your psychology, controlling your emotions. What advice would you give to people that are blithely going about their business, investing the way they always have in Q1 of 2025 with regard to what they might encounter in the coming months and years?
So the first thing is I think have an advisor. I, in my experience with investors over the years, I think a lot of people try to do it on their own, and it's easier to do it today on your own. And I've gone, there's so much research that shows that trying to time markets just doesn't work. But yet, human psychology is we all think we're going to be that one person who can. So I think you need to have that kind of guidance that says, okay, I'm going to pick an asset allocation model because that's asset allocation is the only free lunch in finance. And that's my view. And you kind of got to stick to a long-term plan with it so that you're not trading in or out. You don't take too much risk, right? I think what I have seen is investors take too much risk and they all think that they can time the markets and B, they're going to, as soon as the stock market drops 20%, I'm going to be a buyer. They never are. I've yet to meet an investor who's like that, except some real champions. But I think one of the advantages we've seen we have a very sticky investor base between 2 and 3% turns over a year. And what does that imply? And what insight have I gotten from that? Even if you think that private assets are going to perform the same as they do as publicly traded equivalents, one of the core differences between the two is because you have less of that volatility, you're less likely to be buying tops and bottoms and perform for the long term, and you don't get panicked out or panicked in. And I think that's crucial. I think there was a study, if I recalling, of some mutual funds that had performed exceptionally well. And then they looked at the average experience of investors. Yeah.
It's Dalbar, it's called QUAVE, the quantitative analysis of investor behavior. And
Yeah.
they do it annually. Yeah.
And I remember I think it was Peter Lynch, his fund had performed like 23 or 13. I can't remember the exact number, but the average investor in his fund performed 10 full percentage points worse than his fund did. So that shouldn't happen, but it obviously does because people are buying and selling at exactly the wrong times. So number one, don't buy and sell. Kind of stick to a strategy, and I think you'll be fine over the long run.
Let's see if I can ask you to give me one bit of generic advice to wrap this up. If since the name of the podcast is Make Better Wealth Decisions, what bit of advice would you share with people to help them make better wealth decisions?
I would say the number one would don't do it alone. The world is an extraordinary complex place and very hard to understand. I spend so much time thinking about global macro because it affects my business and I'm trying to position myself. But most people have day jobs. My day job is to do this. And I can still get it wrong too. I do get it wrong. So I think get a good advice. And part of that is Work on an asset allocation model that helps you sleep at night so you can stick to your strategy over the long term. That would be my advice to anybody.
Perfect. Great. I want to thank you for your time today. It's always a pleasure speaking with you, and it's always insightful. And it's great to see people who are prepared to. It's amazing to find that you and I have a very similar view with regard to being evidence based, but we're also mindful of the fact that the world has changed.
Yeah.
And one of the things that I find fascinating is that a lot of the evidence based people that I know and love and respect don't want to acknowledge that the world has changed as a result of reshoring and as a result of this inflationary environment, which is absolutely here to stay for the next probably 5 to 10 years at a minimum.
Yeah. Yeah.
But no one wants to talk about that. So thank you for doing what you do, and we will be in touch.
Thanks very much. Great being here.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.